As Nicholas said, my name is Brett Esber. I'm a partner in the Maritime Practice Group at Blank Rome. I've been doing finance and transaction work for companies in the shipping industry for over 30 years. It's a pleasure to be with you here today. Our panel this morning is focused on commercial bank lending to the shipping industry. I'm going to make just a couple of quick remarks. I'll introduce the panel, and then we'll just proceed with a question and answer kind of a format. So this panel is focused, as Nicholas said, on commercial bank lending to the shipping industry. We're now in the 8th year of the global economic slowdown slant recession that began in the fall of 2008 with the bursting of the housing bubble and the resulting credit crisis. As we all know, the impact of this global economic downturn on the shipping industry was devastating. The buildup of the fleet in all sectors of the industry during the boom years and the continued new building activity during the prolonged bust cycle have resulted in a continuing imbalance of supply and demand for shipping services. At the same time, the tight credit market has been reluctant to provide the liquidity needed to fund the consolidation and other strategic transactions needed to help address the unfavorable market conditions. So it seems that we're living in a new normal environment where traditional shipping banks, once the backbone of nearly every shipping company's capital structure, are just a little less involved. It seems that commercial banks are no longer willing and or able to provide the same pool of funding, typically first lien senior loan financing to the shipping industry. Is that an accurate perception? How long will the new normal environment continue? Will the traditional shipping banks return to their former prominent role anytime soon? What's holding them back? In the meantime, who, if anyone, is filling the gap? So those are some of the questions that were on my mind. To help discuss these and related issues, we've got a panel of experienced bankers with us this morning. Starting on my immediate left here is Michael Parker, who is Global Industry Head for Shipping at Citibank. Next to Michael is Richard Jansen, and Richard is the Managing Director, Global Head of Transportation at Deutsche Bank, and then finally Martijn van Toel, who is Managing Director of DVB Bank. So gentlemen, good morning. I want to start, I think, talking a little bit about the market conditions. We've heard about the dry bulk sector, we've heard about the container sector, we've got an overall economic forecast. I'd like to get your perceptions, and I'd like to start with dry bulk. There is no sector of the shipping industry, except perhaps at times the gas sector or maybe the tanker sector recently, that is not depressed, in other words, significant overcapacity and resulting low rates. Still, the dry bulk sector seems to stand out as especially downtrodden. So I'd like to just go down the line. What's your best guesstimate of when the dry bulk sector will begin to recover? Michael, what are your thoughts?
I think probably by the end of 2018, provided Robert Bugbee doesn't order any new ships.
What was that condition? I'm sorry.
I wanted someone to ask Robert to stand up and swear an oath in front of everyone that he would not order any new ships until 2020. Robert ordered a lot of product tankers a few years ago, and then some bulk carriers. I suppose if one sinner repents, it's a good thing, but I think he's quite right. It assumes no more ordering. I mean, you had the Vale announcement. The demand, as set out in this morning's panel, the demand is pretty flat. So until we see all those older ships scrapped, I don't think any of us would expect demand to pick up significantly. So it's entirely a supply-demand balance, and supply needs to come back into balance. And so by virtue of the order book and the capacity, that would imply, I think, some point during 2018.
Richard, what are your thoughts?
Yeah, I mean, Michael says it right. It's supply-demand driven. So with an anemic demand, supply is the only factor that will be able to right-size the industry in this particular case. On the other hand, I'm no fortune teller, so our approach is generally for companies in the dry bulk space, try to create as long a runway as you possibly can. And if you don't need the money to support your negative cash flow, at some point in time you'll have extra cash to spend at the right time in the cycle and take care of, or be a bit more opportunistic. But for right now, it might be 18, it might be 17, it might be 19. We just don't know. So just go along and hope you're going to be the last one standing.
Yeah. Martin, how about you?
I think the market will come back for different owners at different times. So depends on where your break-even is, depends on how much money you have. For some owners, a prolonged bad market is good because it will shake out other owners. I think the consensus here is that 2018, 19 will have some decent rates again, but yeah, it can be sooner, can be later. It's all about being prepared for it.
Yeah. You know, the sense I get based on comments I've heard is simply that no one sees an improvement in the near future, meaning the next 12 to 18 months, and beyond that, I guess it's hard to say when it may actually come. Okay, it sounds like we have a somewhat of a consensus there. How about on the container side? It seems that consolidation is the order of the day in that sector. Do you agree with that, and do you think that that consolidation will continue? And if so, what role will commercial banks play in the industry consolidation?
Well, I think you've seen, obviously, the COSCO China shipping transaction. You've seen the acquisition of NOL by CMA CGM that hasn't closed yet. And there are probably a few other transactions maybe under discussion. I think what we see is the final arms race, if you like, I mean, the ordering of big ships. And so whilst rates may be terrible, the positioning, the repositioning of the major players to form the new alliances, this is the sort of probable bloodbath of the sector this year in order to create that new sort of consolidated group of companies. So the answer is, I think consolidation will continue and be inevitable. I think second, that sector will begin to then tap the investment grade market at some point. You're going to get more utility like very significant companies. The revenues of the three big players, Maersk Line, CMA and MSC, are over, around $25 billion. Their problem is not throughput, it is the bottom line. So it's about raising the price per TEU. I think commercial banks will continue to play a role, but I wouldn't make any distinction between commercial banks and any other bank. We are advising the Singaporeans on the sale to CMA CGM. We're a lender, a big lender to the sector. I don't see any distinction in terms of financial institution. But I think that the nature of container shipping, very industrialized, will sort of take it further away from some of maybe the bulk shipping markets through this consolidation and through the creation of some really very large, as I said, utilities. The challenge will be for the competition authorities to allow that to happen in a way which shippers don't feel that it's become anti-competitive, but that shareholders of those companies are allowed to make at least a reasonable return, which of course they haven't over the cycle. So I think that's what we see in play. So I think there is an inevitability about further consolidation, which is driven by a number of factors, but one of it is clearly the need for capital, and the scale that those companies will have will tend to mean that, as Hamish said, they don't need so much debt, and of course that will allow these companies to get investment grade ratings and tap the long-term capital those businesses probably need.
This sector of the industry, I caught the end of the container panel. I didn't hear the whole thing, but right at the end there, they were talking about counterparty risk and how the counterparty risk seems to be less in the container sector. These companies are so large, and people have talked about just the importance of liquidity in a runway. Do you agree that generally speaking, these large container companies can just go on longer, than we see companies in the dry bulk sector being able to do, sustaining the kind of losses that they've been sustaining? I mean, do you view this sector as having less counterparty risk than, say, the dry bulk sector or other sectors?
I'm not sure if it's less per se. I think that transparency is better in container liner space as opposed to the counterparty risk in the dry bulk space. what you have to make sure you don't forget is that in the dry bulk space also a lot of vessels get rechartered by various parties. So it's very difficult as a lender or financier to see through the chain actually who is actually providing the cash flow for this vessel. In my career I've seen plenty cases where vessels were chartered up to 7 to 10 times in the chain. So, you know, counterparty risk assessment becomes very difficult. A liner company, you can approach it much more from a utility perspective and a corporate. It still makes it difficult to see through in terms of really figuring out how they make money or not. I have yet to see an analyst really give me a good assessment of a whole corporate in the liner space. So I think there are differences that clearly make it more difficult to assess one or compare one of dry bulk versus containers. But generally, I think the more corporate nature of liner companies makes it a little bit easier. And I think the two factors that are key to look at is overall leverage, or how's the balance sheet levered, and what's their cash flow vis-a-vis liquidity position. And there you could already foresee for quite a few years that, for example, the Koreans, you know, were probably a little bit weakened since the last crisis and haven't actually had a chance or haven't right-sized their balance sheets yet. So to see HMM now in these discussions is not a surprise for people, I think, that are in the industry and in the know.
Yep. Martin, what are your views on the container sector? Do you think they're addressing their issues properly through consolidation, and is there any kind of recovery in the foreseeable future?
When I look at the container industry, I always try to draw comparables with the aviation industry, because they're in many aspects quite similar. You got people, if you have the operator, they run the logistics system. If you're an operator in the container industry, I think your credit risk is far less than when you're a tonnage supplier in the same space and you are beholden to the operator that actually runs your ships. Because when they decide to give it back to you, then you can't tramp it around and you're stuck. While the operator, his credit risk is basically, you know, all the tiny little parties that he moves containers for, and they normally pay. There's a lot of granularity there. So operators in the space, dominant, when they get stuck on chartered in tonnage that's too expensive, they have all kinds of means to renegotiate that. You know, if you ever want to do business with us again, you have to help us, that is it. So there's a big difference there between being a tonnage provider and an operator. As far as consolidation, I think it will indeed continue because it's a capital intensive industry, so people are looking for every form to make economies of scale on the financing, on the ordering, on the assets itself. Scale is very important, absolutely.
Okay. Quickly, let's talk about the other sectors. There's been a little bit of fresh air maybe in the tanker sector recently, in the gas sector. The offshore sector seems to be badly beaten down. Do you see any bright spots or areas where your bank may focus in the near term?
Usually I'm quite creative, but I'm getting to the end of the creativity. It's pretty difficult to find something that you really like, or that, you know, really is a solid project that you feel that has a sustainability to it. Obviously, as bankers, we all approach the better and larger corporates because, you know, it's sort of a natural hedge. You look at the project, but also you have the corporate in case something goes awry. But I must admit, my 15 years or 16 years in this industry, it's becoming a lot more difficult than it ever has been. But maybe Michael thinks it's still easy today.
No, I think, there are some sectors making money, and the issue is shipping, as Robert Bugbee said, never learns its lessons. Unlike the global economy where people use experience to inform their view of the future, it doesn't seem to happen much in shipping, though I think the banking crisis is changing all that, and what we're seeing now, although we've talked most of this morning about shipping, a lot of what's going on is a consequence of the banking crisis, and that is still to play out fully as the major capital providers to the industry. But I think, as Richard says, I mean, we all have clients who are doing things, and we'll all, those of us still doing business, will look to help them. But I think there isn't any significant new demand for ships in any of the other sectors, which are fairly well built, whether it's LNG, LPG, certainly obviously the offshore sector is going through its stresses. What I think there is, and it's interesting that there's a panel later on restructuring. It's the first time I've seen the word restructuring appear again in these conferences. They sort of they disappeared away and renamed themselves consultants. They're now back as restructuring, and we're beginning to see some of that in the dry sector and of course and the offshore sector. So I think there are things to do that are not necessarily around new ships, but are around the extracting of existing private equity or hedge funds, and whether that is through M&A activity, whether it is through other forms of financing. I think there'll be a lot more corporate activity rather than new ship financing that the banks will, whether they are a lender or become a advisor or new lender, will have to sort out over the next couple of years. So I think for those of us in the industry, there will still be plenty of things to do in the foreseeable future, even if it's not financing new buildings.
You know, in the secondhand market, one thing that was mentioned is that privately owned shipping companies who may have little debt and still have significant cash, I guess, left from the boom years, are active in the secondhand market. Have any of your banks gotten involved? That's sort of the traditional role that commercial banks have played, sort of the relationship banker to the privately owned shipping company. Has there been any uptick in your activity lending to those kinds of companies buying secondhand ships?
I wouldn't say an uptick. I mean, it's people are buying. I mean, that's obvious. But the people that are buying at the moment are mostly cash rich, so they buy and see how they will lever up later. There's also the notion there that banks will probably not be there to finance, which I don't think is true. I mean, banks are used to financing all through the cycle, and of course credit committees may have their preference in terms of sectors, but the world is not that easy. Clients are active in all sectors and they expect the bank to be there, and I think it goes for all three of us. We'll try to meet their demands. A little tougher, but definitely there. So people definitely buying ships. So there's good hope for brokers, and there's good hope for bankers, because those are new deals, and we'll be there.
Are any of you expanding your shipping portfolio in 2016 or continuing to shrink it?
I think we have, we'll expand a little bit, as we've always done. That also, it depends a little bit on how much repayments we'll have and how much we'll have to do to keep the book up. But there's plenty to go around, and basically we would love more banks to be active in this space. So it doesn't all depend on the people that sit up front here.
Yeah.
Yeah, same for us. I mean, we have plenty of capacity, both from runoff of the portfolio, obviously, but we also have growth capital. Said it at a previous panel as well, and you know, so I'm not concerned about the availability of capital for the right projects. I think it's just that we still see that both shipping companies as well as private equity type investors are coming to us with propositions that, you know, are still somewhat steeped in the terms and conditions that were possibly available a few years ago. If people were to be approaching banks with a conservatively structured project and are willing to pay the right price for it, I really don't see a concern.
Mm-hmm.
Shipping, I mean, shipping is one of the only few, probably not the only one, but very few industrialized sectors that use term debt to finance themselves, as opposed to the capital markets with large unused revolvers like most of the rest of the industrial sector. So we all have loans that are continuing to be amortized, and so you can sit and do nothing and your book gets repaid, which is, broadly speaking, what's helped Commerce reduce its significant portfolio. So we have all that we could be recycling, and of course if we can recycle at better returns on capital, then we would want to deploy that. And that capital depends clearly upon the risk, and that's the different environment of the last few years, is the regulators telling us what they think we should assign in terms of capital against those books. I think the other thing is there are still a few banks that are still exiting the industry whose own capital commitments to the industry still need to be recycled by other people. And then there are some quite large non-German banks to the industry who are probably coming under some pressure from their regulators to at least keep their portfolios flat to reducing. So in that sense, there is, for those banks still active in the industry, there are still plenty of opportunities should they wish to redeploy that capital. And I think that's the key thing, which is the return on that capital is what's now in focus by the management of banks and the regulators.
Let's talk a little bit about alternative sources of funding. We've heard a lot about credit funds, which are established or that would aggregate investments from private equity funds, hedge funds, insurance companies, pension funds, et cetera. Are these credit funds materializing? Are we seeing them in the market? And if so, are they playing a significant role in providing funding to the shipping industry?
Deutsche has a very large flow business, so we see a lot of this type of money. But particularly for the shipping space, which is, I think, something that is more historic, the pricing of ship finance generally is well below where other asset classes are being priced. At the same time, therefore, also the bid-ask spread of these alternative fund providers is, I haven't seen it larger than ever before. So it's really that they take a different look at the risk in our industry, and I think we should collectively take a good look or really try to understand why they are looking at our industry so differently, because I think they're not unrealistic about really what the risk is, and I think we generally tend in this industry to misprice risk on the basis of the idea that we have an asset that will retain its value. Shipping has a lot of volatility to it, so value is only relative to the point in the cycle where you are, and usually you find yourself needing to exit or do something at the wrong point in the cycle. So you need to not take the high road to value, you need to always calculate towards the low road of the value, and that's, if you price accordingly, then you come to different conclusions. So I think, yes, there are plenty capital, but bid-ask is wide.
Mm-hmm. Anyone have a different view? Anyone seeing these credit funds showing up and being active?
Not yet. People are obviously looking at an industry that is very distressed for capital. So everybody's gut feel is, okay, there's money to be made. But I agree with Richard. I mean, there's a huge barrier of entry because the traditional shipping banks, they just misprice the risk. So we've not been able, because of historic reasons, I guess, to get pricing to a level that we would deserve in this industry. Banks are also providing unfair competition. We get away with 8% solvency on our balance sheet. Try to do that with a fund. Mm-hmm. Nobody can get leverage for 92%. So yes, there's a huge demand for additional capital, but it's a huge area of barrier of entry to compete with banks that misprice and have low solvency requirements. Mm-hmm. It's a weird situation.
Now, the banks must be close to working through the portfolio of shipping loans that were made during the boom cycle. Those have a typical term of 5 or 7 years, and we're beyond that. Are those loans, where does your portfolio stand with regard to that inventory of loans? Are those off the books, or are those still being carried? It seems like just
everybody punted for at least 3 to 5 years. So no, I think the majority is still there. If everybody that is in this industry for multiple decades has a book that is a little bit longer in the tooth than it normally should be. So And even if they were quite proactive, then they still were in the industry in 2010, 11, 12, and they made, for example, a lot of container financings in 11 or 12. The values have reduced since then, and dry bulk, everybody was in it in 2012. So if you didn't already have a problem from the earlier part of the crisis, you exacerbated the problem by actually being through those two cycles. So in the end of the day, it doesn't really matter. You're long on mispriced risk, generally as an institution.
Yeah, no, it seems like everyone involved has been involved longer than they anticipated, whether it's private equity or the commercial banks. Let's talk a little bit about managing distressed debt. I mean, do you have an approach? I mean, it sounds like amend and extend continues to be the approach as opposed to enforcement. Michael, what's the approach of your bank?
Well, let me generalize. Yeah. I think that the change that's taken place is that we're no longer in charge, if you like. The regulators are in charge of all banks, and whether it is the capital you have to assign or the actions you have to take, it's not just your credit committees, your internal workout people, it's a whole load of people, including the regulators, who look at these things in a very granular fashion. So I don't think there is any amend and extend. There is amend and extend if there is further contribution from the equity, which is what was talked about on the dry bulk panel. So I think what banks want to do is to be constructive, but I think that if there is any sort of standoff, banks will in effect be forced by their regulators to take the necessary action. So Robert Bugbee sort of wanted that. I think the problem is banks are not allowed to run shipping fleets. There's no attraction for banks to take possession of ships and sort of manage them and hope for a recovery in the cycle. So I think when we see, if and when we see action, you'll see very quick action, and whether that clearly won't help second-hand values, but I think that unless there are equity contributions made in exchange for banks agreeing to help companies bridge the recovery, if you like, then I think we will see action. So I think the amend and extend, kicking the can down the road, that's all over now. But constructive agreements, the banks are, of course, very interested in.
Yeah, I think it remains about the relationship. And you see generally two approaches. So some people understand and appreciate their banks will help them, but they will have to help the situation as well. And we've had some experience of late as well where people feel that this is now the time to possibly see if you can tip the banks over the edge and come at it fairly aggressively with a non-relationship approach. I think that approach is not going to work today anymore. Maybe 5 years ago, 7 years ago, you could scare a whole bunch of bankers in a room to jump out of the window. No longer, because even if we do it, it's the regulators nowadays that have a much, much stronger say in terms of how you approach your portfolio, how you risk assess, and to what tools in the toolbox you're even allowed to use. Mm-hmm. So I think so long as people take a realistic, constructive approach, as Michael says, really make an effort to bring in additional funds, then there's no reason for the banks to be aggressive or to not help out at the end of the day.
Is there the availability of those funds, though, to keep the banks in place? I mean, are you finding that when you press the borrower in that way, that the borrower finds some way to come up with some money?
Yeah, I mean, also in connection with your previous question, I mean, banks just put on their calculator and try to make sense of the numbers. So taking vessels away from owners may not be a solution in any way. I mean, if there's a different cause for the distress, you may be happy with the owner. Liquidity may be an issue, so you'll try to see if new liquidity comes to the scene. Not that easy, but it still happens.
Yeah.
Yeah, I think this time around, the hands of banks are not forced like that was the case, a few years back when we had the first round, because there's no PE, as far as I see, that buys into debt and starts stirring up things. So a lot of restructurings you see happening now are done the old-fashioned way by bank groups saying, guys, take it easy, what are we going to do? Okay, we need to extend. You guys are going to put new money on the table, fantastic. What do you want in return for that? And that's how we try to solve it. As long as new liquidity comes in, banks can go a long way.
Thank you. Okay, we're coming down to the end of our time, and we wanted to take a moment for audience questions. Are there any questions out there for the panelists? Yes. I'll turn it.
Panelists just talked about the owners bringing in fresh liquidity in their restructuring. That's very important. It shows good faith. But is that likely seems to allude to a regulatory requirement for fresh equity?
Well, no, the issue is the regulators want to see predictability in future cash flows. What the contribution of new equity together with any relief by banks, provides the runway in cash flow terms. Banks just providing it themselves has various capital and P&L connotations for banks. So it's much more difficult for banks to do these things by themselves. What is important is some of the debt that has become distressed was actually quite recent debt, particularly in the dry market where values have fallen even more, but where banks are covered from a collateral perspective still, even though there may be some breach of a covenant or potential breach of a covenant. So the question really is the banks can act without potentially taking a loss. There are clearly some sectors in shipping where to threaten to seize your security is a bit of a sort of pointing the gun at yourself, but certainly in the bulk sectors and the container sector, there are reasonably liquid markets, as we've heard.
Any other questions? One other? Can we take one more?
I'd like each of the panelists to answer. If you isolate your loan facilities as it relates to maritime and shipping, what percentage of those loans are either not performing, either in total default, a technical default because not meeting loan covenants, or your respective regulators have imposed reserve requirements on those loans?
I think generally difficult to say because it's really a reflection of the business models of each bank. So you'd actually really have to do a deep dive on their portfolios. So Citi and Deutsche, we have a more corporate focus. DVB has a more asset focus. The portfolios are going to therefore be composed completely differently. So there is not going to be an easy answer to your question in that sense. Or certainly not some that I could give you publicly either.
Okay. All right, well, our time is up. I'd like to thank the panelists very much and the audience for their attention. Thank you.
The importance is basically a huge get-together for everybody who's connected to the shipping industry. So bankers, owners, brokers. It's a great opportunity to see each other. Low entry level, people just sign up, come in, listen to each other, share a lunch. Yeah, it's a very good opportunity to see everybody in one go. Very short, stay positive. It's a very challenging market for everybody, not the least the owners, but also everybody who makes a living dealing with owners. That's banks, that's brokers, that's everybody. We can use a little positive attitude in this market. I would say that would be the message, yes.
Yeah, there's really two significant things. One is getting other people's perspective on what's happening in the market. I mean, we all follow it in the trade press, but it's good to see whether or not others have the same perception or a different perception. That's one thing. And then the other one is just seeing people. Well, I guess I moderated the commercial lending panel, and I think what came out of the panel was that commercial banking continues to be tight. It's very disciplined, more disciplined than it's ever been in the past, and that banks are very discerning in terms of who they're going to extend credit to. Yeah, I think it's really two things. One thing is hearing other people's perception of what's happening in the market. We all read the trade press, but it's good to see whether others have the same perception or a different perception, and I think it's really important to hear that. The other one is just seeing people that you know in the industry.